Hi everyone, today we're talking about disability insurance. What happens if an illness or injury stops you from working? That's where disability insurance can help protect your income. We'll explore short-term and long-term coverage, claim approvals, eligibility rules, and SSDI benefits. Many people don't know why claims get denied or how to improve their chances of approval. Understanding policy terms, exclusions, and waiting periods is extremely important. By the end of this video, you'll know how disability insurance works and how to choose the right coverage for your needs. Let's get started.
Statistics show that 1 in 4 workers will experience a disabling event before reaching retirement age. For many, this represents a sudden departure from their career path and the loss of their primary source of income. We routinely spend thousands of dollars a year insuring our physical assets, like our homes and our cars, against disaster. Yet we often fail to protect our ability to wake up and earn a paycheck, our single greatest wealth-generating asset. Most professionals operate under the assumption that if illness or injury strikes, Social Security or their employer's group plan will automatically step in and cover their bills. This chart plots the likelihood of a health event against its financial impact. Short-term illnesses happen frequently, but rarely cause long-term insolvency. Long-term disability sits right here, happening often enough to be a statistical threat, with enough devastation to wipe out decades of savings. Protecting yourself against that long-term quadrant involves a specific trade-off, balancing the monthly premium you are willing to pay against the strictness of the policy's fine print. Relying on these assumptions without verifying your specific policy's definitions can leave you with significant financial exposure at your most vulnerable moment. Social Security Disability Insurance, or SSDI, serves as a baseline safety net with zero out-of-pocket costs. However, qualifying requires passing strict federal criteria. The government mandates that your disability must last at least 12 months or be expected to result in death. If you are only partially disabled and can still work in a reduced capacity, SSDI offers no benefit. Employer group plans are common because they're convenient. Enrollment is often automatic, there is no medical underwriting, and no direct cost to the employee. But that convenience comes with rigid limits. Group policies typically cap your monthly benefit and base their payouts strictly on your base salary. If you rely on bonuses or commissions, that income remains unprotected. There is also a significant tax consequence. Because your employer pays the premiums for this coverage, the IRS treats any disability benefits paid out to you as fully taxable income. Furthermore, this coverage is tied directly to your employer. If your health forces you out of your job, or if you simply leave for another company, you lose your safety net. Free baseline coverage provides a foundation, but the combination of rigid rules, benefit caps, and taxes leaves standard corporate workers with a 30 to 40% gap in their take-home income. Individual policies offer more control, but the quality of that protection is dictated entirely by how the contract defines disability, suited to your education and training. A true own occupation policy of whether you choose to work in another field. Securing this level of certainty requires higher premiums and a more rigorous medical and financial underwriting process during the application. You also have to navigate standard industry exclusions. Insurers treat mental and nervous conditions, like severe anxiety, depression, and substance abuse, differently than they treat physical injuries. Payouts for mental health claims are almost always capped at 24 months. To extend benefits beyond that window, you have to formally document a secondary physical condition that prevents you from working. A strict own occupation definition provides a contractual guarantee that an insurance adjuster cannot force you into a lower-paying career outside your field. If you want a strong definition but are concerned about the premium, you can adjust the elimination period to lower the cost. This is the waiting time between the onset of your disabling event and the day the insurance company issues your first benefit payment. Watch how waiting periods impact costs. Extending the elimination period from 30 to 90 days significantly reduces your premium. Stretching that wait to 180 or 720 days lowers costs further, though the savings rate flattens. This strategy requires you to entirely self-insure the gap, living off your own savings for several months before benefit payments begin. Mathematically sizing your liquid emergency fund to cover a 90-day elimination period allows you to permanently lower your lifetime insurance premiums. This diagram outlines a decision tree based on a central rule. The more specialized your job and the higher your income, the more control you need over your policy's definitions. Consider the first path. high-income specialists, medical professionals, and business owners. If you are in this category, relying solely on group coverage is insufficient. You require an individual, true-own occupation policy. The premium serves as a necessary expense to protect the time and capital invested in your specific specialization. Now we look at the routing logic for standard corporate W-2 earners. Your strategy is to utilize employer group coverage as a foundation, while purchasing a supplemental individual policy to cover exposed bonuses and bridge the 30 to 40% tax gap. Finally, we arrive at the final path, the budget-conscious earner. This strategy involves relying on group coverage and purchasing a cheaper individual any occupation policy, while stretching your elimination period to 90 or 180 days. This approach requires prioritizing a 3 to 6 month emergency fund to survive the extended waiting period. The purpose of disability insurance is to match your policy's fine print to your actual career risk, ensuring a health crisis does not lead to a long-term financial one.